What I would like to talk through with you over the next 20 or so minutes, maybe 25 if we stretch it out slightly. I just want to give you some information, but before we go into what we're going to, the subject matter, I felt it appropriate just to give you an overview of my background. I started in financial services a long time ago now, it's coming up 29 years, 1984, which, as I was reminded, was probably when that photograph was taken. And what I have found absolutely fascinating about this industry, and what I still do, is the way that individuals react with our industry. I've worked primarily in the insurance company side, I suppose is the easiest way to describe it, but I did take some time out into the role as an independent financial advisor in my own right. And what I currently get involved in is helping IFAs and advisors generically to get over the value that individual independent advice can deliver to their clients. It's part of a coaching and mentoring type role as well, because the amount of value that independent advice can give to a household is worth not only its weight in gold, but it's beyond any price you will ever pay for it. And you should really bear that in mind whenever you're engaging with any type of professional, whether it be a financial services professional or any of the other types of professions, accountancy, solicitor, etc. What I've been involved in the past, and Jamie's going to talk to you about automatic enrolment, I was involved as an advisor in the pension reform programme as well, so I've got experience of government and some of the issues that are facing society going forward, certainly as we age, and some of the under-preparedness that we have in today's society going forward. But working within my own clients, one of the two areas of fascination for me, the first was pensions, so funding that overall holiday that you have when you finally throw the retirement towel into the ring and think, do you know what, I'm going to enjoy myself now. That's one of my major fascinations. But the other one is looking after the next generation, making sure that people's affairs and orders are in play. Because, you know, we spend a lot of time working. It's not easy, is it? We all complain about paying tax. And then when we do decide to go upstairs, what do we leave behind? We leave behind primarily a mess, and that mess involves normally paying bills, and one of the major bills is getting your estate in order and then paying the tax that's due to the government. Bearing in mind you've built up your estate based on taxed income, hopefully, you then pay additional tax called inheritance tax as we go into death. So I'll talk on that very loosely, but really I suppose it's a challenge to you first and foremost. Here we are, 20 to 7 and Holiday Inn in Taunton. Why are you here? Rhetorical, don't start getting into the interactive bit, but you need to start asking yourselves that, because you've taken time out of your evenings. It's the end of the working day, it's a Monday, there are other places to be on a Monday this time of day. So why are you here? Because I'm guessing at some point, what have you done? Because what you're going to talk about over the next 20 minutes, it's inevitable. I'm sorry, it's going to happen. You will pass away. Hopefully, you don't know when, but it's going to happen. So what have you done? What preparations have you made? Not emotionally, but financially. One of the issues you will suffer, one of the absolute certainties that is going to happen to you is not only death, but is also taxation, that well-worn phrase, death and taxes. And one of the taxes, the only tax in fact that I'm going to refer to, is inheritance tax. So what is it? Well, let me just give you an idiot's guide. I prefer to call it an idiot's guide because I wrote it. And it's basically a cumulative tax based on what you've built up on the day you die. That's it. It's a tax you pay on your estate. Your estate is the value of everything that you own or gifts that you've made over the last 7 years. And it's a cumulative tax based on all of that. How much is it? It's 40%. Now, I'm a great believer in individuals knowing both a percentage number and also a pound amount. So if you've got £10,000, that's £4,000 you give away to the tax man. You give away. Bearing in mind, you may well have already paid 40% income tax to generate that £10,000 worth of wealth. And if you're UK domiciled, and I don't want to go into this, we can pick this up maybe later in the evening, if you're a UK domiciled, hiding assets overseas doesn't always avoid this issue. It's your worldwide assets, basically if you've lived in the UK all of your life primarily. But that's the biggie. It's purely voluntary. You don't have to pay it. Don't have to pay. Well, you do have to pay it, but you can take a choice not to. This phrase of it being a voluntary tax isn't my phrase, I've adopted it. I've picked it up from this guy. Don't know if you remember him. Yeah, Lord Roy Jenkins, fundamental politician. He made some interesting comments around inheritance tax in a tax budget debate back in 1986, and that was the summary of what he talked about. Basically, broadly speaking, it's a voluntary tax paid by those who distrust their heirs, people they want to leave their estate to. They distrust them more than they distrust the Inland Revenue. Okay, you've got two children. You've got two children. You have an estate of £10,000 which is subject to inheritance tax. The tax comes off the top line. That's £4,000. How much is left? 6. Divide that by your two children, they get 3 each. Taxman gets more. You've got 3 children. Children get less. If you've got 1 child, they're all right. They get more as a proportion. That's why this is such a fundamentally important. And I've raised my voice slightly because this is something that people need to understand about inheritance tax. You can completely avoid it if you wish to. And that's some of the ways that I'll talk to you about. Is it a big issue? Well, actually, you should be interested in this because it is a major... We need to carefully balance our debate and discussion here. Because what I'll submit to you is tax avoidance and tax mitigation are two fundamentally different things. What we're talking about is not avoiding the tax, we're mitigating your liability. Because tax avoidance, I think, is probably illegal. And I've just remembered I'm being recorded. One of the issues that we want to talk about is why it is important. In today's society, it's important that we pay our dues going through. The government is in a current crisis, the economy is in a crisis, and it's important that we pay our dues. Now, the slide you're looking at here, I've showed you a table here, and you might be thinking, he's showing me some old stuff. He's not bothered to do his homework. Well, I've stopped. This is the Inland Revenue documentation of inheritance tax receipts. So this is the amount of inheritance tax they've received in the tax years up to, I've stopped this in 2004 and 5. There's a reason. Because between 2004 and 5 and 2011-12, there was a plateau. There was a plateau for a whole host of reasons. Between this date and this date, the estates and the value of receipts that they received from inheritance tax didn't go up. For several reasons. Firstly, the estates themselves weren't going up, but also the allowances and the values, which I'll touch on in a second, had also altered. So should you be interested, well, as a UK dying population, the people that die have paid over £2.91 billion into HMRC's coffers. That could be you, hopefully well into the future, but you could be contributing. That's inheritance that was due to the families that could have been mitigated in some way, shape or form. And is this issue going to get any worse? Well, it is. The reason it's going to get worse is because our estates, the bits that we own, the stuff that we own, is going up in value. And it's going up in value much, much faster than the allowances the government give us. There's something called a nil rate band. That has been frozen. That's not gone up in value at all since 2009. Yet residential property is normally the biggest asset we hold as individuals and families. Residential property since 2009 has increased in value, and it has certainly increased at a higher rate than the 0 increase that we've had in this figure. So just that as a consequence is going to create a higher taxable amount. As I understand it, based on the research I was doing this afternoon, the average house, detached house in Taunton, anyone has to guess, the average detached house in Taunton, any idea what the value would be? Average.
350?
Slightly less than that. It's about 290 to 300,000. That is near enough, a little bit under what's called the nil rate band. So if by the time you get to, say, retirement or earlier into your retirement years, if you've paid off your mortgage and you own your own detached house, you're already threatened with inheritance tax. And the inheritance tax that we received last year of 2.91 billion, that was an increase of 7%. So this is going up. You should be interested, because not only are the receipts going up, Also, the catchment area is increasing as well. So there are ways in which we can mitigate it. And there are two interesting factors you need to understand and accept. The first is, you can't just mitigate your inheritance tax by giving all your money away. And you can't do that the day before you die, because funnily enough, the government have understood some of those issues and they've put in place some actions to ensure that can't happen. So as individuals, what we need to consider, because this affects me as well, is we need to understand when we've got our estate, how much access do we need to the value of it compared to how much saving we can make from an inheritance tax perspective. Now, of course, some of you might be thinking, well, what does that mean? Well, there's a graduating line that comes down here. So if you don't want any access whatsoever, if you don't want any access whatsoever, you're over here. If you want access now and into the future, you go further along here. And this curve tells you that normally what happens is the more access you want, the less effective the strategy you could adopt will be for saving inheritance tax. You can't have your cake and eat it. You can't give the money away today and expect tomorrow, if you were to die, to save inheritance tax if you want access to it this afternoon. It just doesn't work like that. There are various things that we can do to plot along these lines. This is where, whilst when I walked you through my very briefly, my biog earlier on, I'm very well qualified to do the role that I do. But there's a fundamental difference between being qualified in role to being authorised to give advice. I am not authorised in any way, shape or form to give you advice. What I am able to do is give you information. Advice should come from financial services products from an independent financial advisor. Against that background, if you wish to do no planning whatsoever, that is, you want to have full access to your money now and forevermore, you're not going to take any action, guess how much inheritance tax you're likely to save? It's a big fat zero. In fact, you might inflate your estate because by having access to your money and your assets, they may well grow at a higher rate, so your inheritance tax liability might actually increase. And then we can go along this line by insuring against it. This is an insurance policy where you've got access to what you've got and built up in terms of your capital, the value of what you've got. And what you do is you pay for an insurance premium. So in the event of you dying, the value of your insurance policy pays out and it pays the liability. And then we go up the line. I'm not going to walk you through all of these because we could then be drawn into areas of advice. But there are certain vehicles that we could use, that could be plotted on a chart such as this. This is what an independent financial advisor will walk you through in terms of your options. That's the advice I give my mum as a son, because you can completely avoid inheritance tax by spending your money. When I joined this industry in 1984, I picked up very soon after that from a mentor that I was working with, probably the best bit of inheritance tax guidance, and that is your estate should pay out one last cheque the day you die, and it should be payable to your funeral director, and it should bounce. That is perfect. The problem is you shouldn't know the day you're going to die. Okay, that's not right. So if you do spend the money, if this is a process you adopt, and I've tried to tell my mum to do this day in, day out, just be careful what you spend it on, because you need to spend it on experiences and memories. Because it would be very easy to walk away from here and think, do you know what, Richard Sheppard from MetLife, he suggested that one of the areas is to spend my money. So guess what I'm going to buy? I'm going to buy a second house and one overseas, and I'm also going to buy some paintings. That doesn't solve the problem, because that buys you things. They're called personal chattels. And as a result of that, guess what that does? It just moves your assets from cash to something else, and they'll inflate in value. And if you're UK domiciled, it's your worldwide asset. So if you do buy a place, hopefully on a golf course or wherever you would like to do, in Portugal or wherever, if that increases in value, then that's going to create issues. So again, you just need to be mindful of what type of action you take. If mitigating inheritance tax by spending it is a route you wish to take. But before you get to that, you need to actually decide. You need to make a conscious decision as to whether you wish to address this, because this is an issue that is going to creep up on you. I'm 47 years old, it's already crept up on me. It's an issue that I'm considering already. Some people delay that decision until they're 60, until they're 70, until they're 80. In today's economy, in today's environment, we're even seeing investors making the decision at 90 towards 100. Some people may have left it slightly too late. The sooner you make this decision, the better. But there are certain things that you need to decide on. The first is, do you want to do it? Do you want to do it? My dad unfortunately passed away, but he didn't want to leave us a penny. That was his idea. That's absolutely fine. That's his, that's great. There is a phraseology for that. It's called skiers. You might have heard that phrase, spending the kids' inheritance. That's brilliant, and that's what, I certainly encourage my mother to do that. Unfortunately, she's taking that advice, which is disappointing, but, it's always wise to suggest that, I'd rather she would enjoy it. So once you make the conscious decision as to whether you wish to address your inheritance tax obligations, you then need to say, right, okay, if I am going to do something about it, I've got a wedge of capital. Is that capital locked up in a house? Is it in an investment? Is it cash? How much access do I need to it? Is it generating any income, genuine income, not just withdrawals from a bank account? How much access do I need to that income? And is that income regular or is it flexible? All of these discussions and about you need to consider and box off in your own mind in order to come out with a correct course of action or an appropriate course of action. But before we go any further, there is one 4-letter word that you need to consider, and that is a will. Okay, that's 2 words and 5 letters, but you have to have a will. Anybody that hasn't got a will should put that at the top of their agenda for tomorrow morning. Okay, that is purely information, that isn't advice, but it is a strong piece of information. Because without a will, you cannot time the day you die. You shouldn't be able to. And if you were to suffer an unfortunate, untimely death tomorrow without a will, your estate will be in turmoil. Because dying without a will leads you into a position of intestacy, and whilst I'm not an expert in that area, I don't know whether you're going to cover this later on, it's not my area of expertise, it's just unpleasant. If you've experienced it through a family bereavement, it's an unpleasant arena. Unpleasant. It's so unpleasant and potentially so complicated, there's even one of these little forms to follow through where you are, and you have to be careful where you die and all that sort of thing. So please just get a will. Make sure you've got one. Because what intestacy does is it reduces the effectiveness of what you wish to happen. It takes control out of your hands. But by having a will in place, you can give guidance from beyond the grave. You can give guidance from beyond the grave as to what you want to have to happen to your assets. So let's look at ways in which you can mitigate inheritance tax, and these are all approved and accepted ways of mitigating inheritance tax. The first is you can start to gift away some of your assets. The timing of your gifts and the validity of your gifts is important, and there are various different ways in which you can do it. You can do something called exempt transfers, and if you are legally married or subject to a legal civil partnership, those can come into play even after death. For example, if a husband and wife, so myself and my wife, if I'd have been killed in a car accident yesterday, then my wife would have taken my estate on board without any inheritance tax liability whatsoever, because we're legally married, subject to UK jurisdiction, and transfers between spouses and civil partners are exempt for inheritance tax perspective. But there are various other ways in which we can gift. I can make a gift to a third party, and that would potentially fall out of my estate after 7 years. You remember I said about clients approaching their 80th, 90th, 100th birthday. You've got to make sure that if you are going to adopt this approach of using potentially exempt transfers, you've got the time frame issue to talk about. So if you've got somebody who's 100 years old making a gift, are they likely to live 7 years to get the full inheritance tax benefit? And then you've got something called a deed of variation, and again, that's not an area for tonight's debate, but you can make, or those that are left behind can make variances on somebody's estate within 2 years of their death, and that's an area which has been used quite successfully and appropriately. But there are some various other areas I just want to talk to you about in terms of gifting, because you are allowed through legislation to make certain gifts out of normal expenditure. The first is we all have, and this is we're all adults in this room? Yeah, we're all adults, fantastic. So we're all able to make a gift of £3,000 every tax year. And that will reduce our inheritance tax accordingly, because it reduces our estate. And that's an exempted gift, exempted transfer. We can actually make more than 3,000. We can only make 3,000 in total, and if we make 3,000 in total, and that's this year's allowance, and we haven't made a gift for last year, we can use last year's allowance. So this is quite interesting, because the tax year runs from April to April, and hopefully you're aware of that. So now might be an opportune moment, if this is an issue for you, you might wish to look at this sooner rather than later, because here we are fast approaching the end of this tax year. If you didn't make a gift in last tax year, and you were able to, you could afford to give the money away, because you can't gift it away and then borrow it back. That doesn't work like that. You need to give it away, give it away. So you give 3 away now, that uses this year's allowance, and you could maybe dip into last year's allowance as well. In addition to that, we can make what's called small gifts. Small gifts, and you can make any number of these. Sorry for using my notes, but it's important to get the numbers right. So 3,000 is just an annual exemption. Small gifts, and you can make as many as these as you wish to, £250. You can then, if you have friends or family that are going through either a wedding or a civil partnership, an approved civil partnership, you can make